This is the lecture that we are going to discuss today, analysis of financial statements. So the basic idea is that how we can analyze the financial statements that we have already covered in the previous chapters, like if the information that is given in the balance sheet and income statement, how that information can be used to find out the financial position, the stability, the strengths and weaknesses of the companies. So the tool that is used for making analysis of the financial statements, the commonly used tool is ratio analysis. So different ratios are there which can be used to find out the strengths and weaknesses of the companies. Then we are going to discuss DuPont equation, effects of improving ratios, limitations of ratio analysis, and what are some of the qualitative factors that should be considered besides making this ratio analysis. Okay, the data that will be used here for illustration purposes is given in this slide. This is the data related to balance sheet, and it covers the asset side. So comparative data for 2 years is given, 2012 and 2013 is expected data for 2013. So current assets and the fixed assets both are given on this page. This slides cover the liabilities and owner's equity side of the balance sheet. Again, the data for two years are given. 2 years is given. Income statement for 2 years is given. This data will be helpful in analyzing the financial statement. Some other data that we need for making our analysis is what are the number of shares which are issued by the company. So in 2012 the number of shares was 100,000. In 2013 it is 250,000. Earning per share in 2012 is negative. Why? Because there was a loss in 2012, whereas in 2013 there is a profit and the earning per share is $1.014. Dividend per share. Dividend per share in 2012 is $0.110, whereas in 2013 it is $0.220. Stock price, it was low, very low in 2012 because there was a loss. So the impact of that, it was reflected in the stock price of the company. In 2013 the company improved the performance, and hence its stock price increased from $2.25 to $12.17. And the lease payment remained the same in both years. It is 40,000 in 2012 and 40,000 in 2013. Okay, this one. Okay, which one? That was assets, cash, account receivables, inventories. Then total current assets. Total CA is total current asset. So total current asset is these sum of the cash, account receivable and inventories. Then gross fixed assets. Okay, gross fixed assets. From that we have deducted the depreciation. So from the fixed assets, depreciation is deducted to get net fixed assets. So total current assets plus net fixed assets is our total assets. Stock price is the market price of the share, the price which is for one share. How much is the price of one share in the market? That is stock price. Okay, now what is the use of this ratio analysis? Why we need to calculate ratios? Why we cannot do the comparison based on the absolute figures? So the problem with the absolute figures will be the company with the more resources, with more investment into it, more capital invested into it. Obviously the number for that companies will be higher as compared to the company with the small investment into it. So the comparison will not be a meaningful comparison. And once we are looking at the absolute numbers, for example, if we are looking at the net income only, so that just by looking at net income we cannot find out how well the management is doing, how strong the company is as far as its liquidity is concerned, how well the company is doing as far as asset management is concerned. So that is the reason that we go beyond those numbers and we do this ratio analysis. And the purpose is also to look into the efficiency of the company or management, how efficiently the company is utilizing its resources. In the course of this ratio analysis, we'll see that the weaknesses and strengths of the company are highlighted. These ratios are helpful in highlighting the strengths and weaknesses of the company. Three types of comparisons can be done based on ratio analysis. One is the trend analysis, that we can see what is the trend of the company once we are doing the comparison from year to year. On year to year basis, we are doing the comparison that will show us the trend, whether the company's ratios are improving or they are deteriorating. Secondly, we can, if we have the figure for industry, and if we have the industry average available, we can compare one company's performance with the overall industry performance. So it will give us an idea where this particular company stand as far as the industry is concerned. And then another type of analysis can be done is we can figure out the best performing company in a certain industry, and then we can compare the company under analysis with the performance of the best company. So that can be a benchmark analysis. So these three different type of analysis can be done to see to find out the strengths and weaknesses of the company.
Industry analysis is always available.
It's not always available. Sometimes now.
Who issues this industry analysis?
Nobody sees that. That is not some standardized figure, but usually the financial analysts are there who work out this this industry average.
So it's not something which is readily available with the stock market or something like that?
No, that's not something which is coming from the government sector, or it is just some
a figure which they themselves generate.
Right.
Evaluating another.
Right. Okay, these ratios can be divided into 5 major categories. One is liquidity ratios. Liquidity ratios tells us that whether the company is able to meet its short-term obligations. The company has the strength to fulfill its short-term obligations. So the liquidity ratios will help us analyze that. Asset management ratios shows us that how efficiently the company is utilizing its assets in generating the sales and the net income. Debt management ratio, again, that how efficiently the debt is being used by the company in generation of sales. Profitability ratios, they give us an idea that what is the status of profit that is coming from the company, how low or how high the profit as compared to the industry or as compared to the benchmark. And market value is something which is in which investors like what they see as reflected in price earning and market to book ratios. So market value ratios basically give us an idea that where does the company stand from the market perspective. So these 5 categories of ratios are there, and we'll see all of them in the coming slides, that how we can use each one. Market to book ratio. Okay, as far as the liquidity is concerned, these are the 2 ratios, current ratio and quick ratio. These are the 2 ratios which tell us about the liquidity or the short-term financial strength of the company. Current ratio is calculated by dividing current assets with current liabilities. Current assets divided by current liabilities. In this case, the current ratio of the company is 2.34 times. So this indicates that the company's current assets are 2.34 times of its current liabilities. So generally speaking, the general trend is, or general viewpoint is that 2 to 1 is ideal for current ratios. So if your current assets are twice of your current liabilities, that indicates a good liquidity position of a company. Now, quick ratio is a little more, you can say it gives us a more realistic picture of our liquidity. Why? Because from current assets we are deducting our inventories. Inventories is one of the current assets which could be problematic, because if we have old inventory which is not moving, outdated inventory, so obviously that would result in that will be counted in current assets, but that is not a productive asset. So that is why we are taking out the effect of those inventories from the current assets, and then we want to see how far our liquidity position is without minus the inventories. Now in this case you can see when we have deducted inventories from the current assets and then we divided that with the current liabilities, the quick ratio to be 0.84 times. So it is less than even 1. So why it is so? Because the inventories in this case are almost, you can see current assets are 2,680 and inventories are 1,716. So almost 60% or more than 60% of the current assets is composed of inventories. So that is why if we take out inventories from this, the liquidity position of this company is not very strong as it was appearing in case of current ratios.
So what is the ideal index for this quick ratio?
1.5 or close to 2 is, again, it is ideal. Anything between 1.5 to 2. Okay, now in this case,
Inventories, okay, we found out that almost 60% of it is basically
inventory, right.
Can we evaluate that out of this inventory, how much is the dead inventory and because inventories are all bad.
Yeah.
Certain inventories which are good also, which actually help you in your
Right. That is the point.
bad inventories or the dead inventories.
That is the point which is highlighted here, that inventories are one of the reasons because of which this company is appearing strong as far as the current ratio is concerned, but it is weak as far as quick ratio is concerned. Now it is the task of the management to work out, to see that out of this 64% of the current assets which is inventory, how much inventory is useful and how much is which is dead inventory. So then they should work out inventory, they need to work on their inventory management. So the problem is highlighted that inventory management could be a problem for this company. Again, if you look at in this slide now, two types of comparisons can be made. One is the trend analysis, because the current ratio for 3 years, quick ratio for 3 years is given, 2011, 12 and 13. So we can see as far as the current ratio is concerned, it was 2.3 in 2011, it fell down to 1.2 times in 2012, but again it improved a little bit in 2.34. But if we compare this 2.34 with the industry average, so this company is below industry average because the industry average is 2.7 times. As far as the quick ratio is concerned, again 1 times is the industry average, and this company is below that industry average, which is 0.84.
This industry average is of this year.
Usually it is the current year, the most recent one, industry average for the most recent one.
So once we compare it with the industry average, then we should take an average of these three.
Even then it will even fall down, it will further deteriorate. So that it is expected to improve but still below the industry average, and liquidity position is weak. So based on these two ratios that we saw, current ratio and quick ratio, we can conclude that the overall liquidity position of the company is weak.
No, but liquidity position is not weak. It is lower than the industry standard
Right.
or industry ratio. But if you see, as you said, it should be between 1 and 2.
Yes.
It is above 2.
No, not
2.34.
the current ratio. For current ratio it is 2 to 1. Ideally it should be 2 to 1. It is 2 to 1, but why it is 2 to 1? Why it is 2.34? Because of inventories. So that is why we calculated the quick ratio, and quick ratio is below 1. So that indicates that there is some problem there. It should be above 1.
Actually, it is the quick ratio which gives you the position.
That's why I said it is more, you can say, conservative. Quick ratio gives you a more conservative look. So that is why the companies always look to quick ratios as well. Once they calculate current ratio, but they will also refer to this quick ratio as well to find out what is the real position. As in this case, we found out that inventories is a big portion there in current assets. Okay, now as far as the asset management ratios are concerned. So one of the ratio that is useful is to find out inventory turnover. Inventory turnover shows us that the number of times inventory is converted into sales. So how many times the inventory is converted into sales. The formula for calculating inventory turnover ratio is sales divided by inventories. Now the sales, annual sales is total, this is 7,036 is the annual sales. Annual sales divided by the inventory that we have at the end of the year, it is 1760, 1716. So inventory turnovers come to be 4.10 times, 4.1 times. So if you look at the trend of the inventory turnover, it was 4.8 times, it was higher in 2011. In 2012 it was 4.7 times, but in 2013 it decreased to 4.1 time. Whereas the industry average is 6.1 times. So from the industry perspective, it is below industry average. Even the trend of the company itself, it is deteriorating. So inventory management is one of the problematic area for this company. So that is what we can see here. Comments on inventory turnover? Right. That is the.
They are 100 units. Then out of those 100, what they are able to sell is
Next, back one.
This inventory means that the amount of the production which is left at the end of the year.
End of the year, right. That is the unsold inventory, you can say. So inventory turnover is below industry average. The loan might have old inventory or its control might be poor. That's what we concluded. And no improvement is currently forecasted. Why? Because the trend is showing it is going down. So they need to do something to improve. Unless they are not changing their inventory management policy, it is going to go down. So that is why the comment is no improvement. Why? Because they need to do something to improve it. Okay, another ratio that is useful is to find out that average number of days after making a sale before receiving cash. Or you can say that how many days it takes to convert your credit sales into cash. So obviously most of the companies, they sell on credit. Cash sales are less in big industrial setup. Usually there is credit for 30 days, 60 days, 90 days. That is the usual practice. So we want to see that how many days this company is taking to convert its account receivables, which are sales, to cash. So that is called day sales outstanding. DSO means days sales outstanding. The formula for calculating day sales outstanding is receivables, account receivables, divided by average sales per day. Now account receivables for this company are $878. Annual sales are 7,036, and 365 is the number of days in a year. So based on this calculation, we can see that the day sales outstanding for this company are 45.6 days. So it usually takes 45.6 days, or you can say 46 days, to collect your account receivables. So is it good, bad? So just by looking at this, we cannot say anything unless we do some industry average analysis or the trend analysis. Now here we can see it was day sales outstanding. The company was taking 37.4 days in collection of account receivables in 2011, which was pretty good. In 2012, it deteriorated. This DSO, day sales outstanding, the number of days increased from 37.4 days to 38.2 days. But the situation became worst in 2013 when this collection period further increased from 38 days to 46 days. As far as the industry is concerned, industry average is 32 days. So in the overall practice is that the account receivables are converted into cash in 32 days. So we can conclude that the company is collecting sales too slowly and is getting worse. So the company need to improve its credit policy. So two problem areas so far we have identified. One was the inventory management, that needs improvement, and now we saw that its credit policy also needs certain improvement, so that this number of days can be reduced from 45 to at least 32, which is industry average. ठीक है, मतलब थोड़ा सा रेशियोज के साथ साथ जैसे जैसे हम रेशियोज कैलकुलेट करते जा रहे हैं, चीजें अनफोल्ड होती जा रही हैं, कंपनी कहाँ पे स्ट्रांग है और कहाँ पे वीक है. Now again, asset management, how well the company, how efficiently the company is managing its assets. For that we calculate two type of ratios. One is fixed asset turnover. Fixed asset turnover is calculated by dividing when we divide sales with the net fixed assets, we get fixed asset turnover. Now again, sales for this company were $7,036, fixed assets $817. So dividing these two, we get 8.61 times. So 8.6 times is the fixed asset turnover. If we look at total asset turnovers, total assets, sales divided by total assets, so the total asset turnover is less, it is 2.01 time. It means there might be the ratio of current assets is higher in this company. So that's we can see from the analysis. Fixed asset turnover, in 2011 it was 10 times, in 2012 it reduced to 6.4 times, and in 2013 it further it improved from 2012, but still it is 8.6 times. But compared to industry, it is better than industry average. Industry average is 7 times, whereas the fixed asset turnover for this company is 8.6 times. But total asset turnover, it was 2.3 times in 2011. It declined to 2.1 times in 2012. It further declined to 2 times in 2013. So the basic problem is somewhere with the current assets, not with the fixed assets. So fixed asset turnover projected to exceed the industry average. For the trend shows it will remain above the industry average, because for the last at least in 2011 and 2013 it is higher than the industry average.
Sir,
Gigi.
This is 2013 it is expected.
Right.
Like they have the balance sheet for the year ending 2012 and income statements.
All of them are right.
Then basing on that, they see what are the current assets and all those things. Then they calculate this.
Right.
Because
This is expected, this is the forecasted, that what they expect in 2013 to happen. So how they have worked out, okay, we will have a sales of so much in 2013. This is all expected.
this is all based on assumptions.
This is a tool for the management. Actually, it's a tool for the management that, okay, based on their assumptions, this will be the position in 2013. So if the management can take certain steps to improve this, to improve the sales in 2013, or this is what I think it is.
This is just for illustration purpose. Actually, if you are doing an analysis, the assignment your people are getting, you will be doing on this actual figures, whatever has happened. Here, one problem with the financial statement is people say they tell you the history. Financial statement is whatever has happened. They do not tell you about the future. So this is something that they are trying to forecast.
It is, the financial statement does tell us about the history, what has happened, but it also gives you an idea of what you can do in future.
Right.
Because based on all the things, the management, the lower level management.
They are calculating the current ratio. Then how they can forecast that, how are they going to be having their current assets or their current liabilities? It means that they are calculating these figures on the year ending 2012. They are those figures, and then they forecast, yes,
This is just for illustration purpose. Like, forecasting the different techniques and projected एक होता है परफॉर्मेंस बैलेंस शीट वो भी बनाते हैं, प्रोजेक्टेड इनकम स्टेटमेंट भी आप बना सकते हैं। अब अगर आप ये जो करते हैं कि जनाब लेट्स सपोज हमारी 2010 की हमारी सेल जो है वो 1 मिलियन है, 2012 की हमारी सेल 1 मिलियन है, 2013 में हम 30% एक्सपेक्ट करते हैं
इंक्रीज।
आगे 30% इंक्रीज इन सेल की वजह से बाकी चीजों पे क्या इम्पैक्ट आएगा? तो हर चीज आप उसके हिसाब से फिक्स्ड कॉस्ट मे बी दे आर सेम बट वेरिएबल्स कॉस्ट आर गोइंग टू इंक्रीज विद द सेम परसेंटेज। इस तरह की वो डिफरेंट प्रोजेक्ट
जिस तरह वो बजट फोरकास्टिंग करते हैं फॉर द नेक्स्ट ईयर, वो फोरकास्ट करते हैं कि
एक्सपेक्टेड क्या होगा। अच्छा, उसमें भी कई फिगर हो सकते हैं, मतलब 30% में क्या होगा, अगर 25% होता तो क्या होगा, 20% क्या होगा, तो डिफरेंट होगा।
at the end of that year they evaluate that, okay, this was their target, did they meet that target or not, where did they fall short?
एक्सपेक्टेशन आप डिफरेंट भी बना सकते हैं, यानी 2-3 डिफरेंट वर्जन भी बना सकते हैं कि हमारी एक्सपेक्टेशन ये है कि 30%, लेकिन हो सकता है 25, हो सकता है 20। उन सारों को फिर आप सामने रख के बनाते हैं, अच्छा फिर क्या होगा, 35% तो क्या होगा, 38 क्या होगा। तो ये वैसे भी एक आइडिया देने के लिए रेशियोज किस तरह से हम यूज कर सकते हैं। अब इसमें कोई assumption नहीं बताई कि कितने % expect वो कर रहे हैं increase या decrease कर रहे हैं, but they have just given us the figures कि ये होगी expected figures.
This industry is always in local industry.
कौन सा?
ये industry के लोग.
अच्छा हाँ ये local, obviously local market में आप compete कर रहे हैं, तो आप local ही calculate कर रहे हैं. अच्छा उसमें आप जैसे अगर आप KSC की website पे चले जाएं, तो KSC जो उन्होंने listed companies के ग्राफ लिस्ट में उन्होंने सेक्टर्स डिफाइन किए हैं, केमिकल सेक्टर है और सीमेंट सेक्टर है और टोबैको सेक्टर है. अच्छा उसमें जब आप क्लिक करें तो उसकी कंपनीज भी आ जाती हैं कि जी केमिकल में कितनी कंपनीज हैं जो पब्लिकली जिनके शेयर्स हैं स्टॉक एक्सचेंज में. तो एवरेज इंडस्ट्री एवरेज क्या होगी, जो कंपनीज हैं 7-8 कंपनीज हैं उनकी आप एवरेज ले लेंगे, तो वो इस तरह से
Okay, so total asset turnover below the industry average right now. And as we pointed out earlier, it is caused by the excessive current assets. Account receivable and inventory are both there, which are causing this problem. Okay, now another is, now we are talking about the debt management ratios, and in debt management ratios there are these two ratios that we calculate. One is debt ratio. Debt ratio is how much of our total assets are financed by debt. So debt ratio is calculated by dividing total debt with total assets. Now total debt of this company, total debt include both current liabilities and long-term liabilities. So current liabilities plus long-term liabilities, these give us total debt divided by total assets. Total assets, now 44.2% of our total assets are financed by means of debt of this company. 44.2% of the assets are financed by the debt. So almost 66% is coming from the equity. So these are the two sources, how much is coming from debt and how much is coming from the so the company is relying on debt 44.2%. Now another ratio that we are calculating is times interest earned, that we want to compare our net income, operating income with interest charges. So earnings before interest and taxes divided by interest charges. Earning before interest and taxes is for $492.6 and interest charges are $70, so that comes to 7 times. So our earning before interest and taxes is 7 times of what our interest charges are. Again, just by looking at these figures, you will not be able to assess, okay, is it strong, weak, what does it mean, unless you do the comparison.
What does this time interest earned ratio mean?
मतलब आप ये कहते हैं, लेमैन टर्म में आप ये कहते हैं कि जी हमारा जो इंटरेस्ट है एज कम्पेयर टू आवर नेट इनकम वो कितना है, या हमारी आप ये कहें हमारी इनकम जो है उसका कंपैरिजन हम इंटरेस्ट के साथ करेंगे, वो कितने टाइम्स है, इंटरेस्ट के कितने टाइम्स है. जैसे इसमें 7 टाइम्स हमारी जो नेट इनकम है, अगर लेट्स सपोज इंटरेस्ट जो है वो 1000 है तो हमारी नेट इनकम 7000 होगी. इंटरेस्ट ऑन लोन दैट वी हैव टू पे ऑन द लोन, राइट. वो डेट की है ना, दोनों ये डेट रेशियोज हैं, तो लोन भी ये वो डेट के ऊपर जो आप लोन दे रहे हैं और इंटरेस्ट दे रहे हैं, दैट इज व्हाट अर्निंग बिफोर इंटरेस्ट एंड टैक्सेस. Earnings before interest and taxes. So this is the net income, but it includes your interest as well as taxes. Why we have included interest? Because interest is in the denominator. Now the comparison, debt to asset ratio as far the industry average is concerned is it is 50%. So this company is below, in 2013 it is below the industry average, but if you look at 2012 it was 82.8%. It was relying too heavily on debt in 2012. So what could be the reason?
This company had a very bad
2012, and that might be the main reason, because if it is 82.8 times
totally debt.
If debt, it means how much interest would be, as that you can see in time interest earned, it was negative. So it means whatever they were earning, the interest was more than, that was the main reason. So debt to asset and times earned, interest earned are better than the industry average. As far in 2013, they are better than industry average. Yes. Okay, now we move on to the profitability ratios. In profitability ratios, we have these 3 types of ratios. One is operating margin. So operating margin is earning before interest and taxes divided by sales. Earning before interest and taxes is also called our operating profit. So basically operating profit divided by sales. That comes to 7%. Our operating profit as compared to our sales is 7%. Profit margin, that is net income divided by sales. So net income is 253.6 divided by 7,036 is the sales. It is 3.6 times. So you can say that whatever sales you are generating, ठीक है, अगर आपकी 1 लाख की सेल्स हैं तो उस पे 3.6% आपको इनकम होगी. That is what profit margins tell you, कि जितनी आपकी सेल्स हैं उसमें कितना आपको प्रॉफिट मिलेगा, नेट इनकम कितनी होगी. या मतलब ये है कि सेल्स माइनस ऑल योर एक्सपेंसेस इंक्लूडिंग इंटरेस्ट आपका और टैक्सेस, इंक्लूडिंग इंटरेस्ट एंड टैक्सेस, तो आपको बचेगा क्या, नेट आपके पास क्या आएगा, दैट इज 3.6%. And the last is basic earning power. Basic earning power is operating income divided by total assets. So in this case, basic earning power, BEP, isko abbreviation you can write BEP. So basic earning power is 492.6 is the earning before interest and taxes. Total assets are 3,497. So when we divide these two, BEP comes to 14.1%. So again, these figures will become meaningful once we do trend analysis or comparison with the industry. So operating margin, the industry average is 7.3%, whereas in 2013 the company's operating margin is 7. So it is close to industry average, not too way off. Profit margin 3.5%, whereas the company's profit margin is 3.6, again very close to industry average. And basic earning power is below industry average. So why is it so? Basic earning power is below industry average because you can look at the denominator, which is total assets. It means total assets are high as compared to the industry, and in total asset we have already discussed the problem is with the करंट एसेट्स, वो उसके ज़्यादा हैं, इन्वेंट्री और अकाउंट रिसीवेबल दोनों उसके ज़्यादा हैं, जिसकी वजह से इसकी बेसिक करने मतलब अदरवाइज तो प्रॉफिटेबिलिटी इज कंपेटेबल, ऑपरेटिंग मार्जिन इज ओके, प्रॉफिट मार्जिन इज ओके, बट बेसिक अर्निंग पावर इज बिलो इंडस्ट्री एवरेज. वाई? बिकॉज ऑफ द एक्सेसिव एसेट्स, एंड इन एक्सेसिव एसेट्स द प्रॉब्लम इज विद द इन्वेंट्री एंड अकाउंट रिसीवेबल. टोटल नेगेटिव जी नहीं, वो अगर हम पीछे से चलते आ रहे हैं तो उसमें फिक्स्ड एसेट्स में प्रॉब्लम नजर नहीं है हमें हो सकता हाँ हो सकता, लेकिन चूंकि हम तो पीछे से करते आ रहे हैं ना एनालिसिस, तो हमने पीछे देखा है कि वो उसमें टोटल इसके जो फिक्स्ड एसेट्स हैं वो ठीक है, तो अनचेंज है. Okay, now appraising profitability, operating margin, profit margin and basic earning power. Operating margin was very bad in 2012. It is projected to improve in 2013, but it is still projected to remain below the industry average. Profit margin was very bad in 2012, but is expected to exceed the industry average in 2013, looking good. Basic earning power removes the effects of taxes and financial leverage and is useful for comparison. So basic earning power projected to improve, yet still below the industry average. There is definitely room for improvement. That's what we already saw on the previous slide.
इसमें जो आपने जो एनालिसिस जो किया हुआ है, he is actually talking of what is expected to be in 2013, because we are talking about the expected 2013 financial statement. The assignment which we would be doing, we are not going into the future. We are talking of what all happened in the past 3 years. So over there, what would be the assessment like?
Okay, now again, you
If considering that 2013 is the year which just finished.
2012 हो गया ना?
नहीं, अगर हम consider करें इसी में 2013 is the year which finished. So what would be that it has improved? Yeah, the management should take certain steps to improve these things. इसलिए क्या?
अच्छा, थोड़ा सा उसमें मैं आपको बता दूं, असाइनमेंट के पॉइंट ऑफ व्यू से 2 चीजें आपको उसमें हैंडीकैप हैं. एक हैंडीकैप तो बेसिक हैंडीकैप है, इंडस्ट्री अवेलेबल है बस नहीं. तो the only thing that you can do is the trend analysis. आप ट्रेंड ही देख सकते हैं कि
ट्रेंड कैसा है.
उसी की बेस पे आप
not talking of the industry average, लेकिन ट्रेंड इफेक्ट कंपनी का ट्रेंड देख के हम कह सकते हैं कि whether it is going going down or it is going
Trend
up?
में ये तीनों आपकी improvement की ओर जा रही है, जैसे कि profitability इनकी अच्छी है, तीनों positive यानी increasing होनी चाहिए, तीनों यानी profit margin, operating margin भी आपका तीनों साल it should be improving, अगर हो रहा है उसे तो ना तो आप analysis करें, जिससे profit margin भी अगर improve हो रहा है और basic करने के बाद भी हो रहा है तो आप कह सकते हैं कि अगर किसी एक में प्रॉब्लम है, जैसे हमने एग्रीकल्चर या बीईपी में प्रॉब्लम है, बाकी लोग ठीक है, वहाँ भी आप इस तरह से एनालाइज कर सकते हैं कि एसेट्स का बेसिक करने के बाद।
Okay, now there are two other ratios which relate to profitability ratio. Very commonly used ratios are return on assets and return on equity. Return on assets is calculated by dividing net income with total assets. So this is what you are getting out of the investment of the total assets. So your total assets are 3,497 and you are generating a net income of 253.6. So it means your return on asset is 7.3%. As far as return on equity, equity is your shareholder, share capital stock. So how much net income as compared to your total common equity? So net income again is 253.6, whereas the common equity is 1,952. Return on equity is 13%. Return on equity is 13%. So let's see the analysis. Return on assets as far as the industry is concerned is 9%, whereas the company, if we compare the 3 years performance, 6% in 2011, in 2012 it was negative, while the company was in loss, and in 2013 it improved to 7.3%, but it is still below average and there is a room for improvement there. Return on equity 18.2% is the industry average, 13.3% in 2011. In 2012 it was negative 32.5. Again, why? Because in 2012 we saw the company was heavily relying on debt. 82% was the debt. So the return on equity was very low. And it improved to 13%, but still it is very less than the industry average. So wide variation in return on equity illustrate the effect that leverage can have on property. What is leverage? Leverage is borrowing, that is leverage. So this variation in return on equity is because of the loans that the company is getting. As we saw in 2012, the company was almost relying 82% on loans. So too much reliance on loans will bring a lot of fluctuation in your return on equity. Okay, so now what is the effect of debt on return on asset and return on equity? Holding assets constant, if debt increases, right, if we say that our assets are constant but we are increasing our debt, what will happen? Our equity will decline obviously, and interest expense will increase, which leads to a reduction in net income. So one effect of debt, holding our total assets constant, it will be that our interest expense will increase and it will lead to reduction in net income. Now return on assets will decline due to the reduction in net income, or net income decrease, so return on assets will decrease, and return on equity may increase or decrease since both net income and equity decline. So the effect, this is the effect is brought by debt. So if we are relying on debt, obviously it will affect our return on assets, it will affect our return on equity, both.
Net income is all the income after deducting all the
expenses.
All the payments or whatever.
Right.
Interest, taxes, whatever.
Everything. Okay, now the problems with return on equity. So if we are evaluating the company based on return on equity, because most of the time that's what shareholders want, that what return they are getting, so on their equity. So if we are just judging the company by looking at the return on equity, that could be misleading. Why? Because return on equity and shareholder worth are correlated, but problems can arise when return on equity is the sole measure of performance. Return on equity does not consider risk. Obviously, we can, if a company might have a high return on equity, but it does not tell anything about the risk, that how much risk is there. So just looking at return on equity alone, we cannot judge the financial stability of the company.
Which parameter judges how the risk?
वो आगे आ रहा है आगे return on equity does not consider the amount of capital invested, and again another factor, so it is hidden there. Now these problems are because reliance on return on equity may encourage managers to make investment that do not benefit shareholders. As a result, analysts have looked to develop the other performance measures such as EVA. EVA stands for पढ़ा था like quiz लेना पड़ेगा. Economic value added. And what was that? Economic value added?
So the difference of the book value, share value and the market.
No, that was market value added. MVA. That was MVA, market value added. Economic value added. That was our total NOPAT, net operating profit after taxes, minus all the investment that are needed for running our business. So the difference between these two, that was our economic value added. What is the real value added into the business? So that is a much stricter measure as compared to the ROE. So now the analysts, not only they look at ROE, but rather they also look for EVA, what is the economic value added. So just high ROE does not mean that the company is performing very well, but if the company has high ROE and the company has high EVA, economic value added, it means this can be taken as the company is performing well. Okay, now the last category of the ratios is the market value of the ratios, market value of the ratios. So there are two ratios, one is price earning ratio and the other is market to book value per share. Price earning ratio, price divided by earning per share. Price, what price is indicated here? This is the price of share, price per share. So price per share in 2013 is 12.17 and earning per share, net income divided by number of shares. Earning per share is 1.014. So price earning ratio is 12 times. So you can say that the price compared to the earnings per share is 12 times. Now the second ratio is market to book value. Market price, the price which is there in the stock market, whatever the price we see on the stock market, and book value per share. How we calculate book value per share? Book value, the value of share as indicated in our balance sheet. So total common equity divided by number of shares, that gives us book value per share. So market price is 12.17, whereas the book value per share we have calculated by dividing the common equity divided by number of shares. So it comes to 1.56 times. So it's almost, you can say, 1.5 times market price is as compared to the book value of the share. Now comparison with the trend analysis as well as with the industry. Price earning ratio in the industry average is 14.2 times, whereas in 2013 it is 12 times. So it is less than the industry average. Market to book ratio, industry average is 2.4 times, whereas in 2013 it is 1.56 times. So both price earning ratio as well as market to book ratio are below the industry average.
Market price and book value, but is the difference बहुत ज़्यादा होगा तो industry की situation volatile है, बहुत ज़्यादा exaggerated value
बहुत ज़्यादा डिफरेंस इस वजह से भी हो सकता है अगर कंपनी का आउटलुक अच्छा है, मतलब इफ द कंपनी इज प्रोड्यूसिंग और the chances are that the company is going to produce something or the produce high income in future, only then market value can be too high than as compared to the book value. मतलब अगर लोगों का कॉन्फिडेंस है उसके ऊपर तभी वो प्राइस उसकी. But the other thing can also be that it can be fake, it can be just something which is not real. It can be, chances, both possibilities are there.
company की exit value
Exit बता रही है. लेकिन आमतौर से वो उसकी प्राइस जो है, मार्केट प्राइस जो है, वो उसके अलावा भी बहुत सारे फैक्टर्स पे डिपेंड कर रही है। कंपटीशन कितना है, कंपनी का आउटलुक कैसा है, कंपनी हो सकता है कंपनी किसी और फॉरेन मार्केट्स के अंदर एक्सपेंड करने जा रही है, उस तरह की न्यूज़ जो लोगों के पास जाती है, तो उसकी वजह से फिर लोग शेयर प्राइस उसकी हाई हो जाती है। Okay, so analyzing the market value ratios, price earning, how much investors are willing to pay for $1 of earning, price earning ratio, ठीक है, that price earning ratio indicates that how much investors are willing to pay for $1 of earnings, and market to book value, how much investors are willing to pay for $1 of book value equity. For each ratio, the higher the number, the better. So these should be higher. So in your case, if it is higher, obviously you can conclude that the company has higher market value, and price earning and market to book are high if return on equity is high and risk is low. So these two ratios indicate what is the situation of the company as far as the market value is concerned. उसकी market क्या है, लोगों का उसके बारे में, कंपनी के बारे में opinion क्या है.
Does the stock market also play any role in giving a fake price to the share value? जिस तरह normally अगर आप ये land mafia में आप देखेंगे, what happens is that the land mafia which is controlling the price of land, वो एकदम जो है price land की increase करते जाते हैं, investors go in, they purchase, when they find out that the maximum has reached, it crashes.
इसमें स्टॉक मार्केट में भी है, इसी तरह से है, there are mafias जो होल्ड करते हैं,
something is happening, it is rising and everybody goes into that.
कराची स्टॉक मार्केट में मतलब से ये शर्फ के जमाने में एक मतलब वर्ल्ड रिकॉर्ड अचीव किया, इतनी उसकी मार्केट आ गई, तो क्या हो सारा उसमें ऐसा लोगों का कोई माफिया नहीं होता, उन्होंने इतना स्प्राइक किया, बाद में ऐसा पुल किया था सारी प्राइस।
ग्लोबल आपने देखा होगा कि वो क्रैश जो आया था वो ग्लोबली आया था, दैट क्रैश वाज ग्लोबली, इट वाज नॉट ओनली इन कराची और पाकिस्तान स्टॉक मार्केट, इट वाज
लेकिन पाकिस्तान की
इवन अमेरिका तक भी जो है इंडिया
वो हिस्टोरिकल एग्जांपल, कितनी प्राइस पाकिस्तान में कभी भी ऊपर नहीं गई, एकदम सुपर गई अब तक वो
इकोनॉमिक बबल्स भी को कहते हैं,
इकोनॉमिक बबल्स भी है, मतलब ओवरऑल इकोनॉमी का भी इम्पैक्ट आसा
अचानक वो पड़ता है।
लेकिन ये कि ये आपने बिल्कुल राइटली पॉइंट आउट कि इसमें जरूरी नहीं है कि एवरीथिंग फाइनेंशियल स्टेटमेंट्स, इट इज नॉट नेसेसरी, वो माफिया का
वो जो मार्केट वैल्यू है वो है जो माफिया एक्चुअली
ऐसे जब उनका दिल चाहता है किसी एक स्टॉक पे लगाना शुरू कर देते हैं, जब देखते हैं उसका तरीका शुरू करते हैं। अच्छा, इसमें फिर वो इनसाइड इंफॉर्मेशन भी बड़ा रोल प्ले करती है कि आपको
इसमें जो कंपनी के बोर्ड ऑफ डायरेक्टर्स वगैरह हैं वो भी दे विल आल्सो प्लेइंग सम रोल विद द माफिया के, ताकि वो मतलब ये उनके
दे नो कि आपको कितना मतलब हमारा डिविडेंड आने वाला है, ये कंपनी हमारी कोई ऐसा कोई समथिंग इज देयर व्हिच
प्लानिंग चल रही है कि बाय एक्सपेंड
वो पहले से लोगों को पता चल जाए, वो दे स्टार्ट बाइंग इट, प्राइस ऊपर हो जाती है, जब वो अचीव कर लेते हैं तब बस वो सेलिंग करते हैं। सो ऑब्वियसली यू आर वेरी राइटली पॉइंटेड आउट कि सिर्फ फाइनेंशियल स्टेटमेंट्स नहीं, multiple factors. Pakistan में वैसे भी
Okay, DuPont equation. Basically, this equation is to, if you can see, simply it is return on equity. But what we are doing here to calculate this return on equity, we are multiplying profit margin with total asset turnover with equity multiplier. So, profit margin, we know the formula for profit margin, net income divided by sales is the profit margin. Total asset turnover, sales divided by total assets, and equity multiplier can be calculated by dividing total assets with equity. So this DuPont equation, it focuses on expense control, which is profit margin, asset utilization, total asset turnover, and debt utilization, which is equity multiplier. So basically in DuPont equation, we are looking at the combined effect of all these three, that how the expense control of the business is, how asset utilization is, and how debt utilization of that company is. Okay, now we are going to calculate the DuPont equation for this company. the profit margin for this company is 3.6%, total asset turnover is 2 times, and the equity multiplier is 1.8 times. So the return on equity comes to 13%. So now you can see the comparison over the years. In 2011, ROE was 13.3%. In 2012, it was negative 32.5%, mainly because of the losses. And in 2013, it is 13%, whereas the industry average is 18.2%. So the return on equity of this company compared to the industry average is much below. Okay, any confusion about DuPont equation? Because that here the discussion of this. Basically, what we are seeing in DuPont equation, we are seeing the combined effect of 3 ratios. That how it results in return on equity.
But how do we analyze or determine the reasons for this? That does this index somehow give us the reasoning also that we have to evaluate ourselves?
No, then it can give us a trend of return on equity. Then for looking into the reasons, we have to look into the specific of these 3 ratios, that what is separately, like it is shown here, profit margin. Here, the problem here is basically equity multiplier. Which one is the lowest? If you look at profit margin, it is almost close to industry average, 3.6%. Total asset turnover is little less than industry average, 2%, whereas equity multiplier is almost close to the industry average. So from here it is difficult to find out the specific problem, why it is below. But just by looking at this equation, we cannot figure out further.
So then what is the utilization of this?
At least it is giving us a combined effect of these 3 ratios, and we can see that what is the return on equity, like whether it is compatible with industry or not. So that is the only advantage we can see.
All these ratios, profit margin हो गया, total asset turnover हो गया, equity multiplier, all these ratios should be higher than the industrial ratio. Average, it should be higher than that, and then it should be good, or in some it could be the bottom.
At least they should be as good as that. Average means average, right? In a class, there are some outstanding students, some are very, let's say, very weak students. Average are somewhere in middle. So we are just looking at the middle performer. We are not, again, here we are not comparing it with the benchmark. We are not looking at the benchmark.
Like if you see in 2012, the equity multiplier is way above the industrial average. It is 5.8.
5.8. So equity multiplier is what? Total asset divided by equity. Equity was less in 2000. Why? Because
So that means that this should be lower.
This should be lower, sir.
Anything beyond 2 is bad.
right.
This should be lower than the industrial average, because 5.8 very high, and the ROE should not be negative.
5.8. Why it will be higher? Either the total assets are higher or equity is less. One of these factors.
सर लेकिन अगर आप फॉर्मूले में अगर आप देखें ROE की, तो the total assets तो निकल जाते हैं ना. Total assets of the total assets turnover and equity multiplier both cancel out. If you look at the total assets is out, so we are not talking of the total assets.
Right.
So it means you can say it is sales divided by the equity.
Sales भी ऐसे cancel हो जाते हैं.
Sales cancel हो जाती है, so net income divided by equity.
वो net income divided by equity is ROE. We ROE है. वो तो से ROE होगा. Formula ही ROE.
To ये 5.8, this is very high, and you still ROE is negative.
ROE is negative, right? लेकिन combined उसमें आप profit margin negative है, एक factor उसमें negative है, वो उसके
So that much of fact.
basically उसमें loss था, तो अंकल उसका impact तो आएगा इसलिए वो negative है। 2012 profit margin negative है,
नेगेटिव जो भी है सर आपका माइनस
माइनस में चला गया।
हाँ ये भी माइनस ही बताइएगा वो जितना मर्जी
तीनों मल्टीप्लाई हो गया।
वो तो है माइनस में तो जितना मर्जी हो माइनस में रहेगा।
इसलिए एक और चीज another thing should have been minus.
हो गया।
There must have would have multiplied.
वो होने से लेकिन नेट इनकम से बेच में आ रहा, बाकी दोनों में उसने सेल्स किया है, टोटल ऐसा नहीं है, सिर्फ नेट इनकम से
If he could have shown his total assets, he could have gone in minus. Then his ROE isn't it? उनके तो total asset अपने सारे minus तो zero. तो minus plus होता है।
कंपनी नहीं रहती तो फिर क्या करता?
ऐसा चाहिए कोई नहीं
डबल
minus करते हैं ना दो ही देना चाहिए।
डबल शामिल
आप ये अल्टीमेटली उसको करना हो।
ऑल दैट्स
लेकिन अगर वो डेट भी होती टोटल एसेट उसके जीरो होते हैं।
खैर दिस इज अ गुड एनालिसिस
सर का मतलब माइनस
आपने एक पॉजिटिव
जीरो
प्रीमियम तो ये जैसे प्रॉफिट मार्जिन की तरह हो जाएगा।
ठीक है, पैसा नहीं
बड़ी हाई चार महीने देखी मैंने बंद कर दिया।
तो इसमें which is actually used, न्यूटन इक्वेशन is used या वो जो पहले आपने जो ये पांच रेशियोज की
न्यूटन रोटेशन तो अपनी वो
तो ये कोई आ गई ना आरओई आ
तो बेसिकली जो अपने कैंसिल आउट हो गया, सेल्स की करके टोटल एसेट रिजल्ट क्या
Why I think so not a formula, I just take the simple formula of
स्लाइड में थोड़ा सा उसका लॉजिक है, ये जो डायरेक्ट है तीनों का ये बेसिकली होती है, तीनों का इम्पैक्ट है।
focusing on expense control.
एसेट यूटिलाइजेशन और डेट बेसिकली तीन एरियाज को कवर कर रहा है इसमें न्यूटन इक्वेशन। ये और टॉपिक है, नेट रिजल्ट इसका वही आएगा,
वही आएगा।
नेट रिजल्ट वही आएगा। लेकिन आप देखेंगे ना कि आपकी इक्विटी जो रिटर्न दे रही है उसमें कंट्रीब्यूशन किस चीज से ज्यादा है, किस चीज की कंजम्पशन ज्यादा, आपके एक्सपेंसेस पर नहीं कहीं ज्यादा हो गया, उनको कम करके आप इक्विटी ज्यादा इंक्रीज कर सकते हो, आप वो पूरा एनालिसिस कर रहे हो उस इक्वेशन से, तीनों चीजें आपको ज्यादा अच्छी पिक्चर दे रही है इसके डायरेक्टली।
हाँ लेकिन if you look at the values उसमें आपको पता नहीं लगता कि ठीक है ना, आप अगली स्लाइड पे आते हैं ये अगली स्लाइड इसमें आपको ये नहीं पता लग रहा है कि वाई कहाँ पे where the default lie, जिसे कहने का कि मतलब अगर हम फोकस कर रहे हैं तो we cannot find out where the default lie।
2013 में ऑलमोस्ट क्लोज टू इंडस्ट्री एवरेज है, लेकिन डिफरेंस है आर्मी इंडस्ट्री में हाई है,
बहुत 13 और 18%
का
तो जो फाइनेंशियल स्टेटमेंट होती है या जो एनुअल रिपोर्ट होती है उसमें ये सारे एनालिसिस यूज करते हैं या दे डोंट यूज दैट।
ये एनालिसिस को यूज करते हैं, एनालिस्ट यूज करेंगे। तीन बेसिकली इसके मेन आप कह सकते हैं स्टेक होल्डर्स हैं, एक तो फाइनेंशियल एनालिस्ट हैं, उन्होंने एनालिसिस करके आगे लोगों को सजेस्ट करना है या जो आपकी कंपनीज हमको गाइड करना है किस शेयर जो उसमें कंपनी।
अच्छा ये वो कर ये एक्चुअली वो फाइनेंशियल एनालिस्ट जो बैठे हुए हैं
वो कर रहे हैं, या फिर ये बैंकर्स हैं या भी कंपनीज बैंक किसी या फाइनेंशियल इंस्टीट्यूट में लोन लेने जाएंगे वो कहते हैं, वो ये एनालिसिस करके जज करते हैं कि कंपनी की वर्थ क्या है, लोन कितना लोन देना है, कितना सेफ है, रिस्क हमारा कितना है, वो उसको यूज करते हैं। या थर्ड बिल्कुल
मतलब कंपनी खुद नहीं करती
कंपनी है, लेकिन कंपनी
कंपनी मैनेजमेंट
कंपनी जरूर करती होगी, इसलिए वो उनको भी पता है कि लोग क्या करते हैं, ठीक है। तो दे एक इसमें अभी आगे आप प्रॉब्लम देखेंगे, प्रॉब्लम विद द फाइनेंशियल रेशियोज। विंडो ड्रेसिंग एक चीज इसमें यूज होती है, विंडो ड्रेसिंग। हर कंपनी को ये पता है कि 31 दिसंबर वाली हमारी बैलेंस शीट और इनकम स्टेटमेंट एनालाइज होनी है, तो दे ट्राई टू मेक इट एज अट्रैक्टिव एज पॉसिबल।
बैंक में आप देखें बहुत बड़ी, अगर आप उनसे विड्रॉ करिए वो जो है वो कुछ कर लेंगे, आप कहेंगे सर एक दिन रोक लें, कल आप ले लें, आज ले लेंगे।
जैसे कि न्यूज़पेपर में मैंने खोला तो वो कैसे करंट एस्टेट्स हमारे काम की वो हो गए इसमें को ऑब्वियसली फुल पिक्चर 100% पता है कि टैक्स आएगा वही ना, मतलब शेयर बड़ी कंपनी है वर्ल्ड वाइड
ये सही है,
अच्छी चीज देते हैं,
फैसिलिटीज को देता है,
आपने कहा था कि दुनिया में बेटी और यूज नहीं करते, आपने कहा था
अच्छी शो करने के लिए
ये सारे इंडेक्सेस जो हैं सर, ये इट इज ऑफ सम पर्टिकुलर डे।
ये सारे हैं राइट, ये राइट मतलब एनुअल रिपोर्ट अभी आप
जिस तरह वो उसमें लिखा होता है ना कि एज ऑन सच एंड सच डेट।
इन्होंने जनाब सारा काम किया, तो ये आप नहीं ले सकते, इसकी आप नहीं सकते।
किस पे सर क्या पता हमने यही सोच एक्सपेक्ट किया हो, तो फिर ये तो फिर ना वो होगी ना,
इन्होंने सारा काम करके दे दिया।
सर को तो नहीं पता कि किस कंपनी का क्या है, नाम चेंज करें कभी
मैं चेक करूंगा। ये हमारे जो बच्चे हैं ना, वो रिसर्च जो कर रहे हैं वही काम करता है, वो इस तरह करता है। लेकिन उन्हें कंपनी कौन सी थी, मिलन चैट
तो वो जो लोग नहीं कहा मेरा कदर उधर काम करते हैं उसे मैंने मंगवाया था।
इसका नाम प्रपोजल करके कुछ मर्जी का है,
वैल्यूज तो वही होंगी नहीं यार।
इन्होंने हॉरिजॉन्टल वर्टिकल रेशियो एनालिसिस सारा कुछ दिया हुआ है। मतलब जो अच्छी कंपनीज हैं दे आर डूइंग दिस एनालिसिस, वो आपने वहां से ना फिगर से कैलकुलेशन में चेक करना कैसे करेंगे, ये आप देख सकते हैं रेशियो के तो उसमें इन्होंने वो जो मैंने कहा वर्टिकल और हॉरिजॉन्टल एनालिसिस आपने करना है वो ना किया, और 6 साल का दिया है।
कुछ कंपनियों ने ज्यादा से की वो डेटा दी हुई है, बट वी हैव टू कंसंट्रेट ऑन 3 इयर्स, लास्ट 3 इयर्स।
3 का भी मिल जाए तो काफी अच्छा है, कंपनी का होना चाहिए।
हो सकता है उसने भी एनालाइज किया वो पहले से।
अच्छा वो मिल जाएंगे आपको, लेकिन आपने फिगर्स कैलकुलेशन शो करनी रेडीमेड आप।
Okay, now we are going to see one example that what could be the effects of improving ratios, how if we improve certain ratios, how they can affect our financial statements. Let's suppose this is just an example. There is a company in which there are account receivable of $878, current assets, other current assets other than account receivables are 1802, net fixed assets minus depreciation are 817, total assets are 3497. Now if you look at the other side of the balance sheet, there is debt of 1545 and equity of 1952, so total liabilities and equity is 3497. So based on this data, sales per day, sales are 7 million and divided by 365, 19,275.62, that is sales per day. So this is the some information about this company is given. So how would reducing the firm's days sales outstanding to 32 days affect this company? So if we just consider that this company is going to reduce the days sales outstanding to 32 days, so how it is going to affect the company? So initially the company has a day sales outstanding of 45.6 days. So that is the original days sales outstanding multiplied by account receivable. So this is $878,000. These should be tied up in account receivables. Account receivables are 19,275. These are the sales per day multiplied by number of days sales outstanding. So it gives you 878,000 tied up in your cash or in your account receivable. Now if this days receivables are reduced to 32 days, what will happen? So again, account receivables are the same, but your days sales outstanding are reduced to 32. So your total outstanding receivables will be 6,16,820. So how much cash is freed up just by reducing your days sales outstanding from 45 to 32? You can free up your cash. $261,180 will be freed up.
For say for 13 days, cash freed up for 13 days.
Right. If it is reduced to 13 days, so this is the cash which will be freed per day, because the sales per day is there. So 45.6 is this is the $878 you require if your day sales outstanding are 45.6 days. But if it is 32 days, then you need only 6,16,820. So this surplus cash you have now, 2,61,180, which you can use maybe in investment, in marketable securities, whatever purpose you want to, you can earn some profit out of it. Yes. This cash is where you can use somewhere else. Okay, now effect of reducing receivables on balance sheet and stock price. So what could be done with the new cash? You can see that 261, the cash that was freed up was 261,180. So this 261 is now cash in your balance sheet. It will be shown as cash because this is now freed up. Your account receivables reduced. Before, your account receivables were 1,802, now they are reduced to 617. Other current assets, they remain the same, 1,802. So net fixed assets remain the same. So total assets are 3,497. Total assets, there is no effect on the total assets. The only change that took place is between account receivables and कैश. ठीक है, उनकी फिगर चेंज हुई है ना. जो पहले अकाउंट रिसीवेबल थे वो अब आपके फ्री अप होने की वजह से, फ्रीड अप कैश होने की वजह से वो कैश आ गया जो कि पहले आपके बैलेंस शीट में कैश शो नहीं हो रहा था. देयर इज नो इफेक्ट ऑन डेट एंड इक्विटी. सो व्हाट कुड बी डन विद द न्यू कैश? हाउ माइट स्टॉक प्राइस एंड रिस्क बी अफेक्टेड? Now this cash which is freed up, what you can do with it, you can repurchase stock, that is one option. You can expand your business, you can reduce your debt, and all these actions would likely improve the stock price. So just changing one thing, that was your days sales outstanding, that affected basically your balance sheet and that affected your stock price as well. Interlinked. नहीं, डे सेल्स आउटस्टैंडिंग था, जो हमें कैश मिल रहा था 45 डेज में मिल रहा था. हाँ बिल्कुल. नहीं, वो प्रोडक्शन तो आपकी उतनी है, सेल्स आपकी उतनी है, सेल्स आपकी उतनी है, सेल्स चेंज नहीं हुई. क्रेडिट आपके पीरियड रिड्यूस हो गया, सिर्फ वो रिड्यूस होने से आपका कैश फ्री हो गया. हाँ, वो तो उतना ही है, प्रोडक्शन चेंज नहीं है, सेल्स चेंज नहीं है. Okay, now there is one reading I would like to share with you. Okay, look at these. Okay, there are three small readings in this write-up I have given to you. One is looking for warning signs within the financial statements. This is supposed to be 4 pages. You have got 4 pages? 4 pages, right. All right. Okay, so the first reading says looking for warning signs within the financial statements. Now, Enron's decline spurred a renewed interest in financial accounting, and analysts now scour companies' financial statement to see if trouble is lurking. This renewed interest has led to a list of red flags to consider when reviewing a company's financial statements. For example, after conferring with New York University accounting professor Baruch Lev, Fortune magazine's Sean Tully identified the following warning signs. So if you see these in any of the financial statements, it means you should be a little bit cautious. Now, what are those signs? After year, a company reports restructuring charges and or write-downs. So if this is happening time and again, the company is again and again showing restructuring charges, write-downs. So this practice raises concern because companies can use write-downs to mask operating expenses and thus results in overstating earnings. So what the companies are doing, they are, instead of showing those operating expenses, they are showing them as their write-down. So these are not shown in their income statement, rather they will be shown in their balance sheet. So their earnings will be inflated, and that will give a misleading picture. So if you see this is going on, write-downs again and again, or restructuring costs again appearing in the financial statements, that should be something that you should look into. With write-down, like if you say that maybe inventory write-down, you say some of them inventory was spoiled, so you write down your inventory from that position to someone salvage. A company's earnings have been propped up through a series of acquisitions. Acquisitions can increase earnings if the acquiring company has a higher price earning than the acquired firm, but such growth cannot be sustained over the long run. So this should right. Both companies will be having a different margin, and if it is happening like the company is showing these acquisitions, series of acquisitions, like year after year, so that should also be looked into with very careful analysis. A company depreciates its assets more slowly than the industry average. Low depreciation boosts current earning, but again this cannot be sustained because eventually depreciation must be recognized. So obviously you have to, how you can calculate the depreciation, you have to define the estimated useful life. So if you are defining the life more than depreciation cost will be less, your earnings will be inflated, but that should be looked into it with cautious. Now, where can you find out the depreciation policies? These annual reports, if you look at them, the financial statements as I have given to you, maybe 2 pages. One page would be that of the balance sheet and one page would be that of the income statement. But that annual report, that would consist of 100 of pages. ऐसे है ना, आपने जैसे जिक्र किया कि जी 100 pages हैं, तो उसमें क्या है वो, what are all those other pages? Those contain notes to the financial statements. Those notes they specify, उसमें mention होगा कि depreciation कैसे calculate हो रही है, what are the policies of depreciation. From there you can find out के what's going on, क्या industry average क्या और ये company क्या कर रही है. So these are some of the red flags. Now again, a company routinely has high earnings but low cash flow. As Tully points out, this warning sign would have exposed Enron's problem. In the second quarter of 2001, a few months before its problem began to unfold, Enron reported earnings of $423 million versus a cash flow of minus $527 billion. So you can see the earnings are $423 million, whereas the cash flows are negative $527 million. So that should be a danger sign, that if the earnings are too high and on the other hand your cash flows are negative, so it is not a healthy sign. Along similar lines, after consulting with various professionals, Ellen Simon of the New York Star Ledger came up with her list of red flags. You wouldn't buy the stock at today's price. You don't really understand the company's financial statements. The company is in a business that lends itself to creative accounting. The company keeps taking non-recurring charges. Account receivable and inventory are increasing faster than sales revenue. The company's insiders are selling their stock. The company is making aggressive acquisitions, especially in unrelated fields. So again, these are some of the cautious things that should be looked into with the more analysis should be done on that. There is some overlap between these two lists. Also, none of these items automatically means there is something wrong with the company. Instead, the item should be viewed as warning signs that cause you to take a closer look at the company's performance before making an investment. In unrelated fields. So if the company's main business is
once you are having excessive money, economy ज़्यादा अच्छा profit मिलता है। जब हम पहले discuss करें तो अभी बात करते हैं कि excessive money is नहीं।
कहीं भी नहीं, acquisition is something else. That is not investing. Basically you are acquiring those companies. जैसे वो छोटी startup companies आप purchase कर रहे हैं उसमें ही है. Okay, that was one good thing that I found and I wanted to share with you. Now again, the point that we wanted to discuss is this potential problem and limitations of ratio analysis. So the problems with the ratio analysis that can be, some of them are listed in this these notes you can see there. Some of them are mentioned on these slides. So comparison with industry averages is difficult for a conglomerate firm that operates in many different divisions. So it is possible that a company has many divisions or it is operating in diversified industries. So how is it possible for you to compare that company's performance with industry average? It's practically impossible क्योंकि वो एक इंडस्ट्री को तो नहीं वो रिप्रेजेंट करी, उसको मल्टीपल इंडस्ट्रीज को मतलब उसके जो डिविजन्स हैं वो दे आर स्प्रेड आउट इन मल्टीपल इंडस्ट्रीज. इन दैट केस इट विल बी डिफिकल्ट फॉर यू टू कंपेयर इट विद द इंडस्ट्री एवरेज. So that is one limitation you can say of ratio analysis, one problem. Different operating and accounting practices can distort comparisons. Again, one company is using straight line method of depreciation. The other company is using accelerated method of depreciation. Now you cannot compare the performance of these two companies because in straight line depreciation method, depreciation will be less. In accelerated depreciation would be high. So this difference in practice will make it the comparison difficult for you. Sometimes it is hard to tell if a ratio is good or bad, as we practically saw that just by looking at one figure you cannot guess. Difficult to tell whether a company is on balance in a strong or weak position. So just we did analysis of one company. In some areas it was strong, in some areas it was weak, but overall where does the company stand? Obviously every company will have some strengths and some weaknesses. It cannot be said that the company is totally not performing well or the company is totally performing perfect in every field. Obviously it will have some strong and some weak areas. Okay, another problem is average performance is not necessarily good. Perhaps the firm should aim higher. That's what we mentioned, that if we are comparing with industry average, so we are just comparing with average. We are not comparing with benchmark. We are not comparing with someone who is whose performance is outstanding. We are not comparing with that. So basically it should, whatever the company is performing, it should be better than average, not below that average. Another problem with the ratio analysis is seasonal factors. Seasonal factors can distort ratios. For example, Ramadan in Pakistan you can say, or Christmas season. So before Christmas season, all the stores will be stocked up. Their inventories will be very high. So if you are considering the figure of inventory at that time, all the companies will have very high inventory. But immediately after Christmas, it's all gone. It is all converted into sales. So seasonal factors can distort those ratios. And window dressing techniques can make statements and ratios look better than they actually are. For example, if a company borrow maybe for 2 years, let's suppose a company has borrowed 5 million or 10 million from a bank for a period of 2 years, and that borrowing is done in the month of December. Okay, so now that money is with the company. That money will be shown in the balance sheet. It will be shown in the cash portion, that the company has 10 million in the cash, but that loan will not be shown in the current liabilities. It will be shown in the long term because they have taken loan for 2 years. So it is not a current liability, it is a long term liability. So that is a window dressing purely. Why? Because now the current ratio and quick ratio both will be high. Now if the company in the month of January return this money, repay the loan. So that was just to cover that one period. So that was just purely a window dressing technique. That can be done because every company know that their financial statements for the date on which their financial year is ending, they are going to be published. So they want to look good to the public. So they can use these techniques, window dressing techniques. And another factor is inflation has distorted many firms' balance sheets. So analysis must be interpreted with judgment. So as I already mentioned once we were discussing these financial statements, that financial statements are based on gap principles, and one of the gap principle is cost principle, that the assets which are reflected in the balance sheet are on their cost price, not on the current market value. So the current market value of that asset might be many times more than what is shown in the balance sheet. So all of these are some of the problems, and okay, beside looking at these numbers, just calculating the financial ratios and comparing those ratios, there are certain qualitative factors that should also be considered, looking beyond the numbers. What are those factors? Are the firm's revenues tied to one key customer, product or supplier? So that is a very important element. If a company might have very high sales, but majority of those sales might be coming from one customer. So that is not a very healthy sign, because now this company is too much dependent upon that customer. What happens if that customer changed mind, or that customer change buying from some other company? So obviously the sales are going to be very low. Same thing if the company is relying too much on one product, sale of one product only. ठीक है, ऐसी कई एग्जांपल्स हैं. जस्ट थिंक ऑफ दिस पोलराइड कैमरा, क्या था, कोडेक का था, किसका था, पोलराइड कैमरा जो आया था. सो दैट पोलराइड वाज वेरी शॉर्ट लिव्ड, वो तस्वीर ली और आ जाता था उसमें, लेकिन क्या हुआ, वो जैसे ही रिप्लेस हुआ. या आप इसकी सोनी की एग्जांपल है, अगर सोनी वाज टोटली रिलाइंग ऑन दिस वॉकमैन, सो व्हाट वुड हैपन इफ आईपॉड वाज देयर? वॉकमैन तो गया. So if they were totally relying on one product, that company is gone. So that is another factor that should be there. The company should have a variety of products. What if the company is depending on one supplier only? So obviously the company lose its bargaining position if it is depending too much on one supplier. So these are the factors that should be looked into beside the numbers. What percentage of the firm's business is generated overseas? ठीक है, overseas business has its own pros and cons. ठीक है, obviously आप revenue तो ज़्यादा generate कर रहे हैं, लेकिन you have to look into exchange rate as well. Fluctuations in exchange rate, whether it is going in your favor or it is going against you. ठीक है, वो that factor also count. Plus the law and order situation, regulatory environment in that country, that should also be considered once the company is operating in overseas. Firm's competitive environment. What is the situation of competition? If the company is operating in an environment in which there is stiff competition, then investment should be done with great caution. Future prospects. What are the future prospects of the company? How much company is spending in research and development? Is the company coming up with new innovative ideas or not? And the last thing is legal and regulatory framework. So if legal and regulatory environment is not supportive, then obviously take the case of tobacco. So the laws are changing, so you never know that what kind of change can be there in regulations or legal environment which can affect the sales of that product. I'm going to do some practice questions related to this chapter that we have recently covered, analysis of financial statement. Question number 1 is where we have to use the formula for days sales outstanding, DSO. So DSO, days sales outstanding, is equal to account receivables divided by sales over 365. Now in this question number 1, DSO is 40 days, it is given. Day sales outstanding is 40 days. We have to find out account receivables. So account receivables are not given. That is the figure that we need to calculate. Sales are given 7.3 million. Divided by 365. So by solving this, we get account receivable divided by 20,000. So account receivable $800,000 is the amount of account receivable. So the amount for account receivable is 800,000. Okay, question number 2. Price earnings ratio. Price earnings ratio. A company has an earning per share of $2, a cash flow per share of $3, and a price per cash flow ratio of 8.8 times. What is its price earning ratio? So we know that price earning ratio, the formula for price earning ratio is price divided by earning per share. Price earnings ratio. A company has an earning per share of $2, a cash flow per share of $3, and a price per cash flow ratio of 8.8 times. What is its price earning ratio? So we know that price earning ratio, the formula for price earning ratio is price divided by earning per share. Now in this question we are given earning per share, but we are not given the price. We need to find out the price first. So the price is unknown. To find out the price, what thing is useful is we have been given price per cash flow. Price per cash flow is equal to 8 times. Now the cash flow per share is $3. So price divided by 3 is equal to 8. So from this equation we can find out price is equal to $24. From price per cash flow we can find out the price, which is $34. Now since we have this price, we can find out the price earning ratio. 24 is the price divided by earning per share is 2. The price earning ratio is 12 times. Clear? Two things were given, so based on those two things we are able to find out the price per share, price earning ratio. Third one is again a simple question. DuPont Okay, question number 3, DuPont and ROE. Question number 3 is about DuPont equation. A firm has a profit margin of 2% and an equity multiplier of 2. Its sales are 100 million and it has total assets of 50 million. What is its ROE? So we have to find out ROE. We can find out ROE using DuPont equation, which is ROE is equal to profit margin multiplied by total asset turnover multiplied by equity margin, equity multiplier. So DuPont equation, ROE is equal to profit margin multiplied by total asset turnover multiplied by equity multiplier. In this, the data that we are provided with is profit margin is 2%.
So percent is the profit margin multiplied by total asset turnover. Total asset turnover we can find out by dividing sales with total assets. And equity multiplier is given, which is 2. So
this is 2% of sales होगा ना sir?
2% profit margin. That is profit margin already here. It is calculated.
2% of sales. So 2% multiplied by 100.
2% means it is already calculated. Profit margin is net income divided by sales.
So it will be used as 2%.
2%, right? Multiplied by sales is 10 million.
So it will be 8%.
10 million the sales divided by 50 million are the total assets. Equity multiplier is 2. So we can solve it and answer would be 8%. So ROE is equal to 8%. So these three were easier ones. Now number 4 is little bit that's a medium level of difficulty.
Specifically, the company is 50% equity finance. This is the equity multiplier. Yeah. What does it mean? Company is 50% equity financed.
So if you have total equity, out of total equity, 50% will be debt and 50% will be equity. So total equity is given, right?
This is only equity. This no. Because he is given total assets.
So first we have to find out
Equity multiplier.
the total assets so that we can find out how much of it is equity and how much is the liabilities. Question number 4 is about good bond and net income. Eversol Mining has $6 million in sales. Its ROE, return on equity, is 12%, and its total asset turnover is 3.2 times. The company is 50% equity finance. What is its net income? So the useful thing that is given here is the ROE. So basically we need to use the formula for return on equity. This ROE is equal to profit margin multiplied by total asset turnover multiplied by equity. Now, for profit margin, we need net income divided by sales. For total asset turnover, we need sales over total assets. For equity multiplier, we need total assets over equity. Now, in this formula, the basic thing that is missing is total assets. So first we need to find out the total assets. What are the total assets? So
Turnover.
total asset turnover is given. So total asset turnover is equal to sales divided by total assets. Total asset turnover is 3.2 times is equal to sales are given, which is $6 million. Total assets we have to find out. So the total assets are equal to 1,875,000. So by using the total asset turnover formula, we can find out the total assets. Now, actually, what we need to find out is net income. So, putting in the values in this formula for ROE, we have to find out net income. So that is something which is not known. Sales are given $6 million. Total asset turnover is given 3.2. Equity multiplier total asset divided by equity. So equity is not given, but it is mentioned that this company is 50% equity finance. So we have already calculated total assets as $1,875,000. Out of this, 50% has to come from equity. So equity would be 50% of our total assets. 50% of 1,875. So our equity should be $937,500. So total assets 1,875,000 divided by equity, which is 937,500. So now this equation is complete. ROE itself is given, which is 0.12. So now we can solve this equation. Should be 0.12 is equal to 6.4 net income that we can find out divided by 6 million. So further solving this equation, 720,000 is equal to 6.4 NI, and NI net income is equal to 1,125. So the net income is $112,500.
सर सिंपली ऐसे क्यों नहीं चले जाते?
जी, जी,
सेल से क्रॉस होगी, टोटल एसेट्स उससे हो गए, तो जस्ट इक्विटी से मल्टीप्लाई करते हैं ROE को।
नेट इनकम नहीं, तो नेट इनकम तो फाइंड आउट करें।
नेट इनकम रहेगी ना सर?
सेल्स और टोटल एसेट्स माइनस
ROE जो है नेट इनकम रह गया
और
इक्विटी से
तो
मल्टीप्लाई
0.12
इनटू इक्विटी नेट
equity हमारे निकाली थी 937,500 आता सेम
2 into 9,375 वही आया
सेम
आता है भैया।
तो स्ट्रेट अवे ये सिंपल है, इसमें से करना है। सो नेट इनकम 112 so straight away net income divided by equity. The only thing that we needed to find out was equity, और equity हमने पहले उसके लिए total assets find out किए हैं, और इसका 50% जो है वो equity है। So वहाँ से हमें equity मिल गई और ROE is already given.